Hi, in today's class, we are going to be discussing the concept of cost of capital, a very integral part of financial management. And then, of course, cost of capital is fundamental in achieving the optimal allocation of resources. So for this purpose, what is cost of capital? The cost of capital represents the compensation required by the providers of capital from their investment in a company. Providers of capital include the ordinary shareholders, preference shareholders, and then the debt holders. These are the suppliers of funds to the company's operation. It is also known as opportunity cost of capital. The reason being that the suppliers of funds would have invested their money elsewhere, but they choose to put their capital to finance the operation of the business. Therefore, they are expecting a return on their investments. For example, the ordinary shareholders are expecting dividend from their investment in a company whenever a company make profits. Also, the preference shareholders, they're expecting a return in form of fixed dividends from the performance of the business, while the debt holders are also expecting payment of interest on a regular basis until the maturity date, whereby they are going to receive, or the company will repay the principal sum. All right. So, of course, cost of capital is determined by the market forces of demand and supply, depending on the perceived risk associated with a company, which means that the higher the perceived risk, the higher the cost of capital the company will pay. So a company's management must work hard to create value that will be sufficient enough to cover the cost. Okay, so this is a summary of cost of capital. Then we'll move to importance of cost of capital. Cost of capital is essential in the allocation of resources because there's hardly anything you want to do in strategic financial management or corporate finance that cost of capital will not be discussed. All right. Therefore, what are the importance of cost of capital? There are two key importance of cost of capital. One is, okay, let's put it down. Number one, importance of cost of capital is for project evaluation. Okay, project evaluation. What do I mean by project evaluation? In the determination of financial viability of a project, cost of capital will be needed to discount the expected future cash flow to its present value equivalent using relevant investment appraisal technique like the net present value, internal rate of return, okay, modified internal rate of return, adjusted present value, and so on and so forth. The bottom line is that if there is no cost of capital, there will be no way the future cash flow will be discounted to the present value equivalent. Then number two, importance of cost of capital is determining debt equity proportion. Okay. Number two, importance is determining debt equity proportion. Okay. So debt equity mix. The cost of every source of finance. Majorly, there are three major sources of long-term financing, including ordinary share capital, preference share capital, and the debt capital. Each source of finance has its own underlying cost. Therefore, the company may want to know what is the percentage of equity and debt that should be carried in the capital structure or that should be carried in the balance sheet. Therefore, because a company might want to achieve the minimization of overall cost of capital, so because the higher the amount of debt a company carries in a balance sheet, the more financial risk that the company will be exposed to, and vice versa. And then, so the cost of capital will enable the company to be able to say, okay, this is the proportion of equity that I should carry, and this is the proportion of debt I should carry in the capital structure. So these are the two major importance of our cost of capital. Okay, then we'll move to discussing cost of equity. In the determination of overall cost of capital of a company, you need to first of all establish or you calculate the cost of individual source of finance. So we are going to discuss cost of equity, cost of preference share, cost of debt before we be calculating the weighted average cost of capital. So we are starting with cost of equity. What is cost of equity? Remember, when I defined cost of capital, I said cost of capital represents the compensation required by the providers of capital from their investment in a company. And I went on to explain the providers of capital to include ordinary shareholders, preference shareholders, debt holders. So each of those providers of capital, you need to determine the cost, okay, that the company will pay to all of them. So we are starting with ordinary shareholders. So the cost that will be paid to the ordinary shareholders is what is known as the cost of equity. So what is cost of equity? The cost of equity represents the minimum rate of return expected by the ordinary shareholders from their investment in a company. Okay, and of course, that is basically the definition of cost of equity. And this cost of equity can be estimated in three different ways. So that will take us to the methods of estimating cost of equity. Okay, methods of estimating cost of equity. So there are three methods of estimating cost of equity. One is dividend valuation method. Then two, capital asset pricing model. Capital asset pricing model. Then number three, De Miller and Modigliani. De Miller and Modigliani M&M formula. So these are the three methods of estimating cost of equity. So the dividend valuation model is used to compute the cost of equity, where as far as dividend valuation model is concerned, cost of equity represents the relationship between the dividend and then the share price. Okay, so cost of equity will be computed as the ratio of dividend to ex-div share price. So the dividend valuation model will be used to compute cost of equity, where in a question you have information on dividend and then the share price. Okay, so if that is the case, how do you estimate cost of equity using dividend valuation model? Okay, calculating, let me write that, calculating cost of equity using dividend valuation model. So like I said, using dividend valuation model, cost of equity is the ratio of dividend to ex-div share price, depending on whether dividend will remain constant to perpetuity or dividend will grow. Okay, so where dividend will remain constant to perpetuity, then cost of equity will be computed as the current dividend divided by ex-dividend share price multiplied by 100 over 1. So this formula will be used to compute cost of equity, where dividend will remain constant, to perpetuity. That is, dividend will not grow to infinity. So, but where dividend will grow, where there's growth in dividend payment, then cost of equity will be computed as the current dividend multiplied by 1 plus the growth rate divided by xdiv share price plus the growth rate multiplied by, okay, all of this multiplied by 100%. So this formula is used where there is growth, okay, where there's growth in dividend payments. Okay, so that's that. All right then. Now, when you look at this formula, two major things are very common. One is dividend, the other one is xdiv share price. I like to use xdiv share price as the denominator, especially when I'm relating to the students. The reason being that because the dividend to be, the share price to be used to compute the cost of equity must be the share price that excludes dividend. That is, dividend must have been paid before calculating the cost of equity. Therefore, if dividend has not been paid, that means the share price given to you is cum div, and you cannot use cum div share price to compute the cost of equity. So let's explain the concept of cum div and xdiv. Okay, let's talk about cum div first. Cum div share price. Then we talk about xdiv. Share price. Okay, so the cum div share price is the share price that includes dividend. And like I said, the cum div share price is not used to compute cost of equity. So if you want to determine cost of equity and you are given share price and whereby the dividend is still outstanding, dividend has not been paid, then in that case, you cannot use that share price to compute cost of equity. You must first of all deduct the share price from the the dividend from the cum div share price before calculating the cost of equity. So any share price that includes the element of dividend is what is known as cum div share price. Okay, the second one is xdiv share price. The xdiv share price is the share price that excludes dividend. So it is the xdiv share price that must be used to compute the cost of equity. So, but where you are told that the cum div share, the share price is still, the dividend is still outstanding, in that case, you need to convert the cum div share price to xdiv share price. So for this purpose, the xdiv, let me write that. The xdiv share price will be computed as the cum div share price minus the current dividend. So anytime you are given the cum div share price, you need to convert it to xdiv share price. How do you do this? Just minus the current dividend from the cum div share price. It will give you the xdiv share price. So once you have that done, you can then proceed to calculating the cost of equity. So let's talk about growth rates, estimating growth rates. Ordinarily, let me put it down, estimating growth rates. This is denoted as G. So ordinarily, the shareholders will expect that the dividend they are going to earn from the company will grow or will increase over time. No shareholders will want to receive or to be receiving the same amount of dividend every period, all right, or every year. Therefore, it is expected that on a consistent basis, the dividend will grow over time. Therefore, how do you then estimate the growth rate when calculating cost of equity? The growth rate can be computed in two different ways. One is using historical pattern of dividend payments. Historical pattern of dividend payments. Then two, using Gordon growth. Using Gordon growth model. So let's talk about each of them. The historical pattern of dividend payment is also known as averaging method. Therefore, growth rate will be computed using historical pattern of dividend payment. Growth rate will be computed when the history of dividend payment is given year on year, or once you are given the history, the amount of dividend paid, okay, historically, then in that case, you are supposed to use the historical pattern of dividend payment. So there are two basic formulas using the averaging method or historical pattern of dividend payments. Okay, so the historical pattern of dividend payment. So using the historical pattern of dividend payment, there are two formulas that you can use to compute the growth rates. G would then be equal to N, number of years dividend is paid, minus 1 divided by the latest dividend or the current year dividend divided by dividend paid in the first year, all minus 1. So this formula is used when the history of dividend payment is given year on year. For example, you may be given, say you have number of year, you also have the dividend paid. Okay, say you have year 1, year 2, year 3, then year 4. In year 1, the dividend paid was 10 naira. In year 2, it was 12 naira. Year 3, 15 naira. Then year 4 is 20 naira. You can see that dividend has increased between year 1 and year 4 by 10 naira. That is, that's increased from 10 naira to 20 naira. So if that is the case, with this, how do you then calculate your growth rate? So for this, I would just say the growth rate is equal to, using the same formula I have here, number of years is number of n. N is 4 years. So I would then say 4 minus 1 divided by the latest dividend is the current year dividend. The current year is year 4, which is 20, divided by BD is the base year dividend, that is dividend paid in the first year, which is 10 naira, all minus 1. Okay, so mathematically 20 divided by 1 divided by 10 is 2. Then raised to power 4 minus 1 is 3. Raised to power 1 over 3, all minus 1. So mathematically, the growth rate will then be equal to, I'll bring out my calculator to say 1 over 3 is 0.333, whatever. So I would then say 2 raised to power 0.3333, okay? Then equal, then minus 1 multiplied by 100%. So that should give me 26%. So 26%. On the average, dividend has grown by 26% within the last 4 years. So this is, you only use this formula, you use this formula where the information, where the history of dividend paid is given year on year. So this is for this. All right. So then the second formula that can be used to compute the growth rate is where you are given the G, where you are given the history of dividend paid for the first year dividend paid and the current year dividend. In that case, let me say alternatively, okay, alternatively, okay, G could be computed as N into the latest dividend divided by dividend paid in the first year, or minus 1. You can see that this one does not have n minus, it is just n, not n minus 1. So this formula will be used where this should be used where the information on dividend paid in the first year and current year are given. Okay, so where you are given information as per the dividend paid in the current year and the dividend paid in the first year, in that case, you are supposed to use this formula to compute, okay, to compute growth rate. So you may be told that the dividend paid 5 years ago, you may be told that the dividend, for example, the dividend paid 5 years ago is 15 naira. Why the current year dividend is 18 naira. Is 18 naira. So in this case, examiner has given us the history of dividend paid. Okay, we have been given the history of dividend paid in the first year and in the current year. So of course, again, to now calculate the growth rate, I would then say G is equal to N into dividend paid in the current year dividend over dividend paid in the first year minus 1. Therefore, G will then be equal to my N. We have been told that the dividend paid 5 years ago, so N is 5. So here will be 5 into the square root of latest dividend is 18 naira. Dividend paid in the first year is 15 naira. So minus 1. So mathematically, my G will then be equal to 18 divided by 15 raised to power 1 over 5, or minus 1. So I will get my answer. Then G will then be equal to, bring out the calculator. So I will say 18. 1 over 5 is 0.2. So 18 divided by 15 equal, then raised to power 0.2. 1 over 5 is 0.2 equal, then minus 1 equal, multiply by 100% equal 3.7%. So growth rate is 3.7%. Approximately growth rate is 4%. So that means dividend has grown by 4% between within the last 5 years. So this is how to calculate growth rates where the history of dividend paid are given. So the second one is Gordon growth model. Using the Gordon growth model, so the Gordon growth model would be used. The Gordon growth model will be used where the information on earnings and capital employed, okay, are given. So whenever you are given information on earnings and capital employed, then you are supposed to use the Gordon growth model to compute the growth rate. So using Gordon growth model, growth rate will be computed as return on capital employed multiplied by the retention rate. For this purpose, I need to first of all calculate the retention calculate the return on capital employed. So the return on capital employed, R is return on capital employed. Okay, that is return on investment, where B is the retention rate. So I need to first of all go ahead and calculate the return on capital employed, which is calculated as earnings divided by earnings divided by, let me do that again. Okay, earnings divided by capital employed multiplied by 100 over 1. So this will give me the capital employed. So where capital employed is not given, you can use the opening shareholders funds. And you know shareholders funds represent the reserve plus the ordinary share capital. Okay. Okay then. So then the retention, which is B, retention will be calculated as, depending on the information available, retentions will be calculated as earnings minus dividend over earnings multiplied by 100 over 1. But if you are given earning per share, okay, so, or we can say retention is equal to earning per share minus dividend per share divided by earnings per share multiplied by 100 over 1. So depending on the information you have available, these are the ways to calculate the growth rate. However, earnings is the same thing as profit after tax. Okay, earnings is the same thing as profit after tax. So this is how to calculate growth rate. Now, we are currently discussing methods of calculating cost of equity, and we started with dividend valuation model. So the capital asset pricing model is a topic on its own. So when we get to capital asset pricing model, subsequently, you are going to learn about capital asset pricing model. Then when we get to adjusted present value, we are going to use the Miller and Modigliani formula to calculate cost of equity long geared. All right. So now we have discussed dividend, all the concepts using dividend valuation model. We started with how to estimate cost of equity using dividend valuation model. So we calculated, I demonstrated how to calculate cost of equity where dividend will remain constant to perpetuity. I also discussed how to calculate cost of equity where there's growth in dividend payment. Okay, these are the two formulas that we have provided to calculate cost of equity. I also explained to you the meaning of cum div share price and ex div share price, and how to convert cum div to ex div share price before calculating the cost of equity. Then finally we discuss how to estimate or how to calculate the growth rate. I said there are two methods that you can use to calculate growth rate. You can use averaging method or use Gordon growth model. And I also demonstrated the formula that can be used for each of them. So now that we are done with this, let's have a short example to demonstrate our learnings. Let's have a short examples. Okay. Yes. Example number 1. So Arsenal PLC is financed. Arsenal PLC is financed with 10 million ordinary shares of 1 naira each, currently quoted at 1 naira 25 kobo cum div. So the share price is cum div. The company's current dividend of 22 kobo is about to be paid, and this dividend will remain constant to perpetuity. You are required to calculate the company's cost of equity. So you want to calculate cost of equity. At this point, you need to ask yourself, how do I calculate the cost of equity? Am I using dividend valuation model? Am I supposed to use capitalized pricing model, or I'm supposed to use Miller and Modigliani? And I told you, whenever you have information on dividend and share price, you are supposed to calculate cost of equity using dividend valuation model. So in this question, we are given a dividend of 22 kobo. We're also given current share price of 1.25 kobo. In this case, I'm supposed to calculate cost of equity using the dividend valuation model. Calculating cost of equity using dividend valuation model, cost of equity will be calculated as the ratio of dividend to ex-div share price. So I will go to the question, what is the current dividend? The current dividend is 22 kobo, so that's 0.22, because there is no growth in this question, because we are told that dividend will remain constant to perpetuity, then divided by ex-div share price. So my ex-div share price, I don't have the ex-div share price because examiner has given me cum-div share price. Therefore, I need to go and calculate the ex-div share price. Ex-div share price will then be equal to the cum-div share price minus the current dividend, okay, minus the current dividend. So the cum-div share price we are given is 1.25 kobo. Current dividend is 22 kobo. Therefore, my ex-div share price will be 1.03. Okay, that's the ex-div share price. I will then come here 1.03 multiply by 100 over 1. I will get my answer. Okay, I will get my answer, which is 0.22 divided by 1.03. Okay, then multiply by 100. So that's that. 21%. 21% is the growth rate. Sorry, is the cost of equity, which is the same thing I've done here. Okay, then that's how to calculate. In this particular question, examiner wants to test your understanding on how to calculate cost of equity where dividend is constant, and then how to convert the cum-div share price to ex-div share price. Let's have another example. This example number 2, let's try it. In the example number 2, you are told that Martinelli PLC is financed with 20 million ordinary share capital of ₦1 each, currently quoted at ₦1.25 kobo. The company's current dividend of 20 kobo is about to be paid. So the current dividend has not been paid. It means that the share price of ₦1.25 kobo is cum-div, and this dividend will grow at a rate of 5% per annum. So there's growth rate. So since there's a growth rate, this is the formula I'm supposed to use to calculate the cost of equity. All I need to do now is to slot in the numbers. However, my current dividend is 20 kobo. That's the 0.2 you are seeing there. Then 1 plus the growth rate, the G, has been given to me as 5%. So 1 plus 5% will give me 1.05. Then the denominator is the ex-div share price. I don't have the ex-div share price. Examiner has given to me the cum-div share price to be ₦1.25 kobo. So cum-div share price is ₦1.25 kobo. So I will then say ₦1.25 kobo. What's wrong with you? It's not connecting. Okay. Let me put this back. So the cum-div share price is ₦1.25 kobo. Then I will less the current dividend of 20 kobo, 0.2. Therefore, my ex-div share price is ₦1.05 kobo. So that's the ₦1.05 kobo that we are seeing here. So put it in the form plus the growth rate. Everything multiplied by 100%, then the growth rate is 25%. So you can see the working here. Okay, how to convert the cum-div to ex-div share price. All right, let's have one more example. Okay, example number 3. Pate PLC is a company with 5 million ordinary shares of ₦1 each, currently quoted at ₦1.40 kobo as at 31st December 2022. The company's current dividend of 30 kobo is about to be paid. Again, dividend has not been paid. That means the ₦1.40 kobo is cum-div share price. The historical trend of the company's dividend is given below. Okay, so examiner did not tell me that dividend will grow. However, because examiner has given to me the history of dividend paid from 2017 to 2022, then in that case, I need to go and calculate growth rate because I've been given the history of dividend paid year on year. Therefore, my growth rate will be computed as n minus 1 into the latest dividend divided by dividend paid in the first year, okay, all minus 1. So in this case, I will just put in my number. G will then be equal to n is 6 years from 2017 to 2022. That's 6 years. So 6 minus 1 into square root. Latest dividend, the current year dividend is 30 kobo. Dividend paid in the first year is 15 kobo, all minus 1. So mathematically, my growth rate will be 30 divided by 15, that's 2. Then raised to power 6 minus 1 is 5, raised to power 1 over 5, all minus 1. So G will then be equal to, I'll bring out my calculator to say 2 raised to power 1 divided by 5 is 0.2, raised to power 0.2 equal, then minus 1 equal, multiplied by 100% equal. So growth rate is 15%. So the growth rate is 15%. So if the growth rate is 15%, I still cannot go ahead to compute my cost of equity because I don't have the ex-div share price. Since the share price given to me of 1 naira 40 kobo is cum div, I need to convert that cum div to ex-div share price. Therefore, the ex-div share price will then be equal to the cum div share price of 1 naira 40 kobo minus the current dividend of 30 kobo, okay, 0.30. This will give me 1 naira 10 kobo. So that's the ex-div share price. Now that I have the ex-div share price, I can then go ahead to calculate my cost of equity. Therefore, using the formula for cost of equity where there's growth, the current dividend is 30 kobo. Growth rate I calculated is 15%. All right. The ex-div share price I calculated is 1 naira 10 kobo. Okay, that's the 1 naira 10 kobo you are seeing there. Growth rate is 15%. Mathematically, put it in the formula. Then you are going to get, the calculator will give you 46%. So this is how to calculate cost of equity, where historical pattern of dividend paid is given year on year. So in this particular example, examiner wants to test your understanding on how to calculate cost of equity where there is growth, how to calculate cost of equity, or how to convert cum div share price to ex-div share price, okay, and also how to calculate growth rate using the historical pattern of dividend payment. Okay, so that's that. Let's have this example number 4. Let's have the example number 4. Okay, let's have the example number 4. Morino PLC is financed entirely by equity. The company has 150,000. Okay, 150,000 ordinary shares of 1 naira each, currently quoted at 3 naira 42 kobo. So the current share price is 3 naira 42 kobo ex-div. So that means I don't need to make any adjustment on this share price. It's already ex-div. The company's current dividend of 6,158 naira was paid recently out of the company's earnings of 62,858 naira. So there is earnings of 62,858. Once I've seen information on earnings, something should be calling me that okay, there is likelihood I may calculate growth rates. Okay, the capital employed of the company is 315,000 naira, and a dividend of 2,473 naira was paid 5 years ago by the company. Required, what is the company cost of equity capital? This question is very interesting. Number 1, because I have information on earnings as well as the capital employed, that means I'm going to calculate growth rate using Gordon growth model. Not only that, I'm also given the historical pattern of dividend payment because the history of dividend paid 5 years ago was given to me to be 2,473 naira. I'm also given the information on the current year dividend to be 6,158 naira. So in that case, I'm going to calculate two different growth rates. If I have two different growth rates, then it implies that I need to calculate two different costs of equity. All right. So that's basically that. So I need to go and do my working first. I will calculate the growth rate using the historical pattern of dividend payment, I will also calculate growth rate using the Gordon growth. So let's go and do that. So working first. Okay, so working number 1, using the historical pattern of dividend payment, because I'm given the history of dividend paid in the first year and also in the current year. So I'm supposed to use this formula. The current year dividend is 6,158 naira. The dividend paid 5 years ago is 2,473 naira. 5 years ago is the end. So 5 into square root of 6158 over 2473 or minus 1. Mathematically, using your calculator, the growth rate is 20% using the historical pattern of dividend payment. I will then go ahead and do working for growth rate using the Gordon growth. Because why am I using Gordon growth mode? Why am I calculating Gordon growth? I'm calculating Gordon growth because because of the fact that in the question I'm given information on the earnings. I'm also given information on the capital employed. Okay, earnings, return on capital employed. Okay, return on capital employed, which is R. Right, or you can call it a rate of return or return on investment. Okay, R, you know that growth is R multiplied by B. R is the rate of return. Okay, then B is the retention rate. So I need to calculate the return on capital employed, which is earnings divided by capital employed. Earnings in the question is 62,858. Like I mentioned, earnings is the same thing as profit after tax. Capital employed is 315. Multiplied by 100%, we got rate of return of 20%. Then I need to calculate the retention rate. My retention rate will be computed depending on the information on the earnings given to me. If I have information on earnings, it will be earnings minus dividend divided by earning. But if I'm given earnings per share, then it will be earnings per share minus dividend per share over earnings per share multiplied by 100%. But in this question, I'm given earnings. Therefore, earnings of 62,858 minus dividend of 6158 divided by 62,858 multiplied by 100%. I got retention of 90%, which means I'm paying dividend of 10%. I'm retaining 90% in the business. So putting it together to get my growth rate. So my growth rate is return on investments multiplied by the retention rate. That's 18%. So I've calculated the growth rate as 18% using the Gordon growth model. So the next thing I need to do now is to go and calculate my cost of equity. So I need to calculate cost of equity using the historical pattern of dividend payment. So using the historical pattern of dividend payment, of course, the formula will remain the same, whether you are using the historical pattern of dividend payment or you are using the Gordon growth. The formula will remain the same. The only thing that will change is your growth rate. Therefore, in this side, I want to use the absolute number. Okay, in this side, I also use the power value. I will still get the same thing. If I want to use the absolute number, meaning that I'm going to use the total amount, the total dividend over total market value of the equity. Okay, the total dividend given in the question is 6,158 naira. The growth rate we computed for historical pattern of dividend payment is 20%. Okay, this is the 20%. Okay. Oh, sorry, it's down there. Yeah, this is the 20% growth rate. So that 20% is what I'm using here to calculate this is the 20% you are seeing there. So put it, then of course, the market value of the equity, the ex-div share price. So the ex-div share price is per share. So I need to calculate the total market value of the equity. In this case, I will multiply the ex-div share price with the number of share of 150. 150,000 multiplied by 3.42 will give us 513,000. So the numerator divided by the denominator plus the growth rate of 20%, all multiplied by 100% will give us 21%. So that is that. If I now want to use power value instead of using absolute number, my dividend is in absolute figure. The market value, the denominator is also in absolute figure. So if I want to use power value, because my ex-div share price of 3.42 kobo is in power value, then I need to go and convert my dividend per share. I need to go and calculate dividend per share because the dividend given in the question is an absolute number, 6,158 naira. So I need to convert that to dividend per share. You know, dividend per share is total dividend. Okay, total dividend of, for example, total dividend of 6,158 divided by number of shares. Number of shares is 150,000. So this will give you 4 kobo, 0.04. That is how we arrive at this 0.04. Put it in the formula, the cost of equity still remain as 21%. So whether you use the absolute number or you use par value to calculate your cost of equity, you still get the same thing. Then number B, using the cost of equity using the Gordon growth model. Again, the value of dividend will still remain at 6,158. Value of the market value of equity will still remain at 513,000. But the growth rate using the Gordon growth is 18%. Look at this is the 18% that we have here. This is the 18%. So that 18% is what I'm going to use. So put it in the formula. Then we got 19%. So using Gordon growth, cost of equity is 19%. So in this case, in this particular one, I use the absolute number. If I want to use par value, then I will say cost of equity will then be equal to my dividend per share is equal to 0.04. Growth rate is 18%. 1 plus 18% will give me 1.18. Let me write that one. This should be 1.18. What's wrong with you? Okay. 1.18. So 1.18 divided by SDIV share price is 3 naira 42 kobo plus the growth rate of 18% plus 0.18. All of this multiplied by 100 over 1. So I should have the same thing as 19%. So I would then say 0.04 multiplied by 1.18, okay, equal divided by 3.42 equal plus 0.18 equal multiplied by 100% equal, that's 19.38, approximately 19%. So whether I use absolute number or I use par value, I'm supposed to get the same thing as my cost of equity. Okay, as my cost of equity. So at this point, let's move to we are moving to cost of preference share. Okay, cost of preference share. So we are done. Okay, we are done with estimating cost of equity. Let's talk about cost of preference share. So let's discuss cost of preference share. The cost of preference share represents the rate of return expected by the preference shareholders in form of a fixed dividend from their investment in the company. In the event of liquidation, when a company liquidates, of course, the assets will be realized, will be disposed of, and then the proceeds therefrom will then be used to settle the liabilities. So the preference shareholders will be paid before the ordinary shareholders is paid, but after the debt holders must have been paid. Okay, so the preference shares could be cumulative, non-cumulative, participating, non-participating, redeemable, or irredeemable. So of all these forms of preference shares, only the redeemable and irredeemable are calculations. Every other ones are purely theoretical. So like the cumulative preference share, for example, if a preference share is cumulative, it means that in any year the company make loss, okay, whereby the company will not be able to pay the preference dividend. So you are going to carry the dividend forward until the company is able to make profit. Say, for example, in the first year, the company make a loss, okay, the company makes loss. So the company will not be able to pay the preference dividend. So you carry forward to the following year. If in the following year, the company is still not able to make profits, then you'll be cumulating the preference dividend. The dividend of year 1 plus the preference dividend of year 2 will be carried forward to the third year. If in the third year the company is able to achieve profit, then from there you pay the outstanding preference dividend. So if there is a balance, then you also carry forward until the company is able to pay the entire preference dividend. This is what is called cumulative preference dividend. But if it is not cumulative, that means in any year the company does not make profits, then there won't be any preference dividend that will be paid. Okay. Now that is for that. So let's talk about irredeemable and redeemable preference share. Okay. Let me look for a space. Yeah, let's talk about irredeemable first. Cost of irredeemable preference share. KP. So the cost of irredeemable preference share is the one in which the company, if a preference share is irredeemable, it means the company will pay only the fixed dividend to perpetuity, but the principal amount will not be repaid. Okay, I take it again. The irredeemable preference share is the one in which the company will pay the fixed dividend to perpetuity, but the company will not repay the principal at the maturity date. So the cost of irredeemable preference share will be computed as the ratio of fixed dividend to the ex-div share price. So the cost of irredeemable preference share is computed as the ratio of fixed dividend to the ex-div share price multiplied by 100/1. So where there is irredeemable preference share, this is how to calculate the cost of the irredeemable preference share. Just divide the fixed dividend with the ex-div share price. All the principle on how to convert cum div to ex-div share price still apply in this one too. Okay, so that is that. At this point, let's have example to demonstrate that. Let's have an example. Okay, let's do this example. Adenine PLC has an issue preference share with the nominal value of 25 kobo. The agreed dividend of 5 kobo has just been paid. Okay, required. What is the cost of a preference share? This is straightforward. So the dividend is 5 kobo. The nominal value, there is no market value. So nominal value is the value in the balance sheet. So which is 25 kobo. Therefore, the cost of preference share, cost of irredeemable preference share will then be equal to 5 divided by 25. Okay, 5 divided by 25. So this is it. This is the formula you are supposed to use. So the answer, the cost of irredeemable preference share is 20%. That's 20%. 5 divided by 25 is 20%. Okay, so that is how to calculate cost of irredeemable preference share. So let's talk about cost of redeemable preference share. Cost of redeemable preference share. Okay, a redeemable preference share is the one in which the company will pay the annual fixed dividend and the principal at the redemption dates. So the cost of redeemable preference share is computed similar to the way internal rate of return is computed. So when you want to calculate the cost of redeemable preference share, there are 3 stages. The first stage is to compute, is to assume two discount rates that will produce 2 opposing NPV. One discount rate will produce positive NPV, then another discount rate will produce a negative NPV. Then, of course, you then proceed to calculate the internal rate of return, which is the redeemable preference share, which is the cost of redeemable preference share. So that's what you need to do when you want to compute cost of redeemable preference share. So let's have example just to demonstrate that. Let's have this example number 2. Okay, Johnson PLC is financed with 1 million redeemable preference shares with a nominal value of 1 naira and the nominal rate of 8% but currently quoted at 1 naira 5 kobo ex-div. The preference share will be redeemed at par in 5 years' time. So again, the preference share will be redeemable if and only if the redemption date is given in a question. Where you are not given the redemption date, then you are going to compute as cost of irredeemable preference share, because the redemption date is very important, is vital in the calculation of cost of redeemable preference share or even redeemable debt. So to solve this question, what am I supposed to do? I'm going to assume two discount rates that will produce two opposing NPV. One discount rate will give me a negative NPV, then another discount rate will give me a positive NPV. Then I will now put in the variables, the answers. I'll put it in the internal rate of return formula. That's all I need to do. Therefore, let's go and calculate positive NPV and negative NPV. Okay, so we're assuming 5% as the first discount rate. I need to go and determine the current market value. How do I get the current market value? The number of shares is 1 million. The number of shares is 1 million. The market price of this preference dividend is 1 naira 5 kobo. Therefore, 1 million shares multiplied by 1 naira 5 kobo will give me 1,050,000. So that's 1,050,000 naira. So that is how we got the 1,050,000 that you are seeing there as the current market value. So the current market value multiplied, discount factor at year 0 is 1. 1,050,000 multiplied by 1 will give me 1,050,000. So I need to go and determine the fixed dividend. How do I get the fixed dividend? Okay, to get my fixed dividend, according to the question, we are given the nominal rate to be 8%. So the nominal value is 1 million naira. How do I get the nominal value? Nominal value is equal to the 1 million shares. The 1 million shares multiplied by nominal price per share, which is 1 naira, multiplied by 1 naira. So this gave me the nominal value of 1 million. So the balance sheet value, the face value of the preference share is 1 million naira. Therefore, the fixed dividend that the preference shareholders will earn is 8%. So the fixed dividend will then be equal to 1 million naira multiplied by 8%. That is what gave the 80,000 naira. So the dividend for year 1, all throughout the next 5 years, the company will pay fixed dividend of 80,000. That's how we arrive at this 80,000 here. So I need to calculate annuity factor of year 1 to 5 at 5%. Therefore, I would then say 1.05. Okay, 1.05 raised to power 5 minus equal minus 1 equal divided by 0.05 equal, that's 4.329. That's how we got the 4.329. 80,000 multiplied by 4.329 will give us 3,463.20. So at the redemption date, at the final year, so I need to redeem the preference share. How am I going to redeem the preference share? Is it going to be redeemed at par, at a premium, or at a discount? If it's going to be redeemed at par, that means at the nominal value. And you know the nominal value is 1 million naira. If it's going to be redeemed at a discount, that means to be less than the 1 million naira. If it's going to be redeemed at a premium, it will be more than the 1 million naira. But we have been told in the question that it will be redeemed at par in 5 years' time. So par value is 1 million naira. That's why you are seeing the 1 million naira here. Then discount factor for year 5 at 5%. So 1.05 raised to power 5 minus will give us 0.784. That is 0.784 multiplied by 1 million will give us 784,000. 784,000 plus 3,463.20 minus 10 million minus 1,050,000 will give us 80,320. So we have assumed 5%. We got a positive NPV of 80,320. So to get a negative NPV, we need to increase our discount rate. So we assume 10%. So our cash flow still remain the same. In year 0, it is 1,050,000 multiplied by 1,050,000 present value. Our fixed dividend is still 80,000. Now that we're assuming 10% discount rate, I need to go and calculate annuity factor at 10%. Therefore, 1.1 raised to power 5 minus 1 equal divided by 0.1 equal. That's 3.791. That's how we got this 3.791. Multiplied by 80,000, we give us 303,280. Then in year 5, I need to discount this. So discount factor at year 5 is 0.621. So 0.621 multiplied by 1 million naira will give us 621,000. 621,000 plus 303,280 equal minus 1,050,000 equal. We got a negative NPV of 125,720. So we assume 5%, we got a positive NPV. We assume 10%, we got a negative NPV. All I need to do is to slot in into the IRR formula. A is the lower discount rate of 5. NPV of that lower discount rate of 5 is 80,320. Okay, divided by NPV of the lower discount rate of 5, which is 80,320, plus the NPV of the higher discount rate of 10, which is 125,720. B is the higher discount rate of 10 minus lower discount rate of 5. Mathematically, our cost of redeemable preference share is 7%. So this is how to calculate cost of redeemable preference share. This is how to calculate cost of redeemable preference share. So that's it. Okay, so that's how to calculate cost of redeemable preference share. All right, so let's see from our outline for today. So we are done with calculating cost of preference share. Let's talk about cost of debt. The cost of debt is the compensation required by the providers of debt capital. It is the actual amount paid on the loan borrowed. Okay, the interest expense that the company will pay on the loan borrowed represent the cost of debt, because the debt holders that are expecting the company to pay regular interest, fixed interest, okay, until the company is able to pay back the principal sum if it's a redeemable debt. However, debt is a cheaper source of financing because of tax deductibility benefit. As a result of financing with debt capital, the company is going to benefit, is going to have some kind of a tax relief or tax benefit as a result of that. Therefore, that's why debt is seen as a cheaper source of financing. Okay, it's a cheaper source of financing, and in the event of liquidation, once a company liquidates, the debt holders will be paid before the preference shareholders and then the ordinary shareholders. All right. However, there are different forms of debts. We have redeemable and irredeemable preference shares. Debts. We have redeemable and irredeemable debts. We have we have callable and non-callable debts. All right, we have callable and then non-callable debts. However, the focus is on the redeemable and irredeemable. The callable and non-callable debts, they are theoretical. They don't involve calculation. So what do you mean by irredeemable debt? So just like you have redeemable and irredeemable preference share, so the irredeemable debt is the one, let me put it down, the cost of irredeemable debt, KD. So the cost of irredeemable debts is the one in which the company will pay annual fixed interest to perpetuity, but the principal will not be repaid. So the cost of irredeemable debt will be computed as the ratio of fixed interest to X int price, depending on whether there is tax or there is no tax. All right. So like I said, the cost of irredeemable debt is computed as fixed interest divided by X int price. That is the interest, the price that excludes interest expense. So multiply by 100 over 1. This formula is used where there is no tax. So where there is no tax, that's when you use this formula. But where there is tax, then cost of irredeemable debt will be computed as the fixed interest multiplied by 1 minus tax rate divided by X int price. Okay, multiply by 100 over 1. So this formula is used where there is tax. Let me write it. Where there is tax. So that's when you use the second formula. Okay, so let's have illustration to that effect. Let's have illustration. So in this example, Aberdeen PLC is financed with 10 million naira 9% redeemable debenture quoted at 102 naira. Interest on debenture was paid last week. What is the cost of debenture if 1. The company is not liable to pay tax, 2. The company tax rate is 40%. So you have been told that this is a 9% redeemable debenture. Like I mentioned, debenture will only be redeemable if the redemption date is given. That is, when the company will pay back the principal sum. That's the redemption date. That's the maturity date. So in this question, we are not given the redemption date. So whenever you are not given the redemption date, then it is going to be calculated as cost of irredeemable debt. So in this case, I want to calculate cost of the debenture where the company is not liable to pay tax. So it will be calculated as the ratio of the fixed interest. The fixed interest is 9%. You know, debt is always quoted at 100 naira per unit, except examiner says otherwise. Therefore, 9% of 100 naira will give us 9 naira. So just forget about the percentage. Whenever you are given the coupon rate, just use the value itself. Forget about the percentage. So this will now be 9 divided by X int price. The X int price, we are told that interest on debenture was paid last week. It means that this market price of the debenture of 102 naira is already X int. So it is X int price. Therefore, this will be 9 divided by 102. Okay, so that's what you are seeing there. The fixed interest divided by the X int price, since there is no tax, and that's why we got 9%. In the second part of the requirement, we are told that if the company tax rate is 40%, what is the cost of the debenture? In this case, you need to change your formula. So your formula will then be the fixed interest multiplied by 1 minus tax rate. Tax rate, the interest is 9%, which is 9. Okay, the fixed interest is 9 naira, then tax rate is 40%. 1 minus 40% will give us 0.6. Therefore, 0.6 multiplied by 9 will give us 5.4. 5.4 divided by 100, 102 will give us 5%. So the final answer is 5%. So this is how to calculate cost of irredeemable debt, okay, where there is tax and where there is no tax. You can see that because of tax benefit, instead of the company to pay 9% cost of the irredeemable debt, but the company will only pay 5% because of tax benefit. So it is cheaper to finance with debt where there is tax because the company will earn tax benefit. Okay, so that is for that. So let's go back to redeemable debt. Let's go back to redeemable debt. So this is cost of, we have discussed cost of irredeemable. Then let's talk about redeemable debt. Cost of redeemable debts. So the cost of redeemable debts is similar to cost of redeemable preference share. The cost of redeemable debt or the redeemable debt is the one in which the company will pay both the annual fixed interest and the principal at the maturity date. Okay, so the cost of redeemable debt is computed as internal rate of return. Okay, all you need to do is to assume two discount rate that will produce two opposing NPV, then you calculate internal rate of return. That internal rate of return is cost of redeemable debt. Cost of redeemable debt is the same thing as, it can also be called yield to maturity. Okay, it can also be called yield to maturity. So at this point, let's have an illustration to that effect. Let's have illustration just to demonstrate how to compute cost of redeemable debts. Okay, so let's have this question on Ateta. Ateta PLC has a 10% redeemable debenture in its capital structure. The debenture is currently quoted at 106 Naira x interest, and it will be redeemed at par in 5 years' time. Examiner has given the redemption date to be 5 years' time. Required, calculate the cost of redeemable debenture. So in this case, since the redemption date is given to us as 5%, in that case, all I need to do is to calculate internal rate of return. How do I calculate the internal rate of return? I will assume two discount rate that will produce two opposing NPV. First thing first, I assume 5%. If I assume 5%, I need to calculate the current market value of the debenture. Okay, I will then go back to the question. What is the market value of the debenture? According to the question, we are told that the debenture is currently quoted at 106 Naira x interest. That 106 Naira is the current market value per the unit of the debenture, and it is 106 Naira. So that 106 Naira, I don't need to make any adjustment because I've been told that the interest has been paid. Therefore, that's why you are seeing the entire 106 there. Then discount factor at year 0 is 1. 1 multiplied by 106 is 106. Then I will move on. I need to go and determine annual fixed interest. I will check from the question, am I given tax rate? If I'm given tax rate, I need to adjust for tax because the interest I'm going to pay will be lower if I have tax rates. But if I'm not given the tax rates, then the coupon rate is the same thing as the fixed interest that I'm going to use. In this question, we are not given tax rates. Therefore, the interest expense will then be 10%, which of course is 10 Naira. And that's why you are seeing 10 here. So I need to calculate, because I'm assuming 5%, I need to calculate annuity factor of year 1 to 5 at 5%. That is what produced 4.329. 4.329 multiplied by 10 will give us 43.3. Then at the final year in year 5, I need to check, how is this debenture going to be redeemed? Is it going to be redeemed at par, at premium, or at a discount? Examiner has told us that it will be redeemed at par in 5 years' time. At par means at 100 Naira, because debt is always quoted at 100 Naira per unit. No examiner will give you the par value. The par value, you should know that it is 100 Naira, except examiner wants to do otherwise. At times, if it is bond, you may be told that federal government bond will be quoted as 1,000 Naira. So, but if examiner is silent, you are going to assume it is quoted at 100 Naira. So discount factor for year 5 at 5% is 0.784 multiplied by 100, that's 78.4. 78.4 plus 43.3 minus 106 will give us a positive NPV of 15.7. So we assume 5%, we got a positive NPV of 15.7. We need to increase to 10% to get a negative NPV. So at this point, the cash flow will still remain the same. So I need to calculate annuity factor of year 1 to 5 at 10%. This is what produced 3.791. So the discount factor for year 5 at 10% is 0.621 multiplied by 100, that's 62.1. 62.1 plus 37.9 minus 106 will give us negative NPV of 6. Now I have assumed 5%. I got a positive NPV of 16 approximately. I also increased to 10%. I got a negative NPV of 6. Therefore, what am I supposed to do? Just put in the numbers into the internal rate of return formula and you are good to go. So this is the formula for internal rate of return. Put in the NPV and other variables into the formula. The final answer is 9%, which means that the cost of redeemable debenture for Ateta PLC is 9%. Okay, that's it. That's it. So let's have illustration where there is tax. Okay. Let's have this example number 2. Ronaldoli PLC has an 8% redeemable debenture currently quoted at 103 naira as at today, 28th December 2018. The debenture will be redeemed at par. Okay, will be redeemed at par on 1st January 2022. The company has a policy of paying dividend interest, debenture interest, every 31st of December. What is the company cost of debenture? If 1, the company is not liable to pay tax. 2, the company tax rate is 40%. Again, so this particular question, examiner did not give us the redemption date, but we are told that the company always pay dividend. Of course, we are told that it will be redeemed at par on 1st January 2022. That's the redemption date. And we are told that today is 28th December 2018. So how many years is this debenture? So you are going to start counting. 2018 is already gone because this is December 2018. Before you can count a year, before you can recognize a year, you have to count for 12 months. Therefore, December 2018 is already gone. So full year 2019, full year 2020, full year 2021. That's 3 years. 1st of January 2022, when this debenture will be redeemed, it's not a year. So that's the beginning of 2022. So you cannot count that one as 1 year. Therefore, 3 years is the redemption year. I mean, the next 3 years is the redemption date for this particular debenture. So, like I said, the debenture will be redeemed in 3 years' time. Okay, in 3 years' time. Okay, in 3 years' time. Now, so if that is the case, you have been told that the company is not liable to pay tax. So where the company is not liable to pay tax, so all I need to do is to just go and calculate my NPV. So I will assume 10%. If I assume 10%, the current value of the debenture, what is the current value of the debenture? We are told that the debenture is currently quoted at 103 naira. That's the current market value of the debenture. So I need to check if the debenture interest has been paid. We are told that today is the 1st of January 2022, and then the company usually pays interest every 31st of December. This is January 2022, so they have not paid interest. So the interest is still outstanding. So if that is the case, then I need to deduct the amount of interest from the market price of 103. The interest is 8%, which is 8 naira. 8 minus 103 will give me 95. So, and that is why you are seeing this 95 here. So, multiply by 1, that's 95. Then, annual fixed interest. Since there is no tax, the annual fixed interest is just the coupon rate of 8%. And then, that's the 8th day. So, I need to calculate annuity factor at 10% for year 1 to 3. Because the maturity date is in the next 3 years. So, annuity factor for year 1 to 3 is 2.487 multiplied by 8. That's 19.9. Then, how am I going to redeem the debenture? We are told that the debenture will be redeemed at par. Okay, the debenture will be redeemed at par. At par means at 100 naira. 100 naira multiplied by annuity multiplied by discount factor at year at 10% for year 3, that's 0.751 multiplied by 100, 75.1. So 75.1 plus 19.1 minus 95 will give us 0 NPV. So since I have 0 NPV, there is no point of calculating internal rate of return again. Why? Because the internal rate of return is the rate that equates NPV to 0. Any discount rate that you use to compute NPV and it produces 0 NPV, that rate is the internal rate of return. Therefore, the cost of the debenture, if the company is not liable to pay tax, is 10%. Do nothing. No need to calculate internal rate of return again. Then the second part, where the company tax rate is 40%, then I need to go and calculate NPV. Okay, so I assume 5%. So The market value, the current market value of the debenture is still 95 x int price. So that's the 95 you are seeing there. So since there is tax of 40%, therefore, and then the interest is 8%, I need to calculate post-tax interest. Okay, I need to calculate post-tax interest. The post-tax interest is the interest of 8% multiplied by 1 minus tax. Tax rate is 40%. Therefore, 1 minus 40%, that means we are supposed to account for 60%. So 60% of 8 will give us 4.8. That's how we got that 4.8. Then I will calculate annuity factor of year 1 to 3 at 5%, which is 2.723. 2.723 multiplied by 4.2 will give us 13.1. Then at the final year, which is year 3, this debenture will be redeemed at par, which is 100 naira. Discount factor at 5% for year 3 is 0.864. Multiplied by 100, that's 86.4. 86.4 plus 13.1 minus 95 will give us 4.5. So we got a positive NPV of 4.5 using 5% discount rate. So because our NPV, the first discount rate produced a positive NPV, we need to increase to 10%. So when you increase to 10%, I'll need to calculate annuity factor of year 1 to 3 at 10%, which is 2.487. 2.487 multiplied by 4.8, that's 11.9. At year 3, which is the final year, I need to redeem the debenture. Okay, therefore, I will calculate discount factor at 10% for year 3, which is 0.751. 0.751 multiplied by 100, that's 75.1. 75.1 plus 11.9 minus 95 will give us negative 8 NPV. So, I assume 5%, I got a positive NPV of 4.5. Then I increased to 10% discount rate, I got a negative NPV. At this point, I need to put it into internal rate of return formula. And I then put it in the formula, I got 7%. So the cost of redeemable debenture, where there is tax of 40%, is 7%. Okay, it's 7%. So all those things I talked about, these are the workings for that. So that's it. That's it. So at this point, let's move to let's go back to the scope. So we are done with cost of redeemable debts. What else do we have for the outline for today's class? So we are done with cost of debts. Then let's talk about types of debt. There are two major types of debts. Okay, let me find a space. Types of debts. Okay, so there are two major types of debts, including one, we have traded debts. Then two, we have non-traded debts. What do you mean by traded debts? The traded debts are fixed income securities that are tradable. That is, they are fixed income security that can be bought or sold in an organized financial market. Examples of traded debts include 1, bond, 2, debenture, then 3, loan notes. So these are the examples of traded debt. Like I said, traded debt are fixed income security that are tradable in an organized financial market. You can buy and sell traded debts in the market. You can buy bonds. You can sell bonds, debenture, loan notes in the market. So the non-traded debts are securities that are not tradable. Okay, non-traded debt are securities that are not tradable. They are securities that cannot be bought or sold in an organized financial market. Examples include bank loan. Okay, bank loans. Then 2, overdraft. You cannot take your bank loan to the market and sell or buy. It's not possible. Same thing with overdraft. You cannot sell your overdraft facility. That's not possible. Okay, so these are the examples of not traded debt and then traded debt. Okay, so majorly there are two types of debt. Like I mentioned, traded debt and then the non-traded debt. So that's gone. So let's move to, we have talked about how to calculate cost of debt. We've done that already. Then finally, let's talk about weighted average cost of capital. Let's talk about weighted average cost of capital. Then after that, we talk about how to estimate cost of capital, the categories of cost of capital. So we are getting close to the where we are going to have a bigger illustration. Okay. Now, what do you understand by weighted average cost of capital? The weighted average cost of capital represents the overall cost of capital to a firm weighted according to the proportion of each source of finance in the company's total pool of capital. So when you talk about weighted average cost of capital, it simply means the overall cost of capital. So far, we have calculated cost of equity, which is the minimum rate of return expected by the ordinary shareholders. We also calculate cost of preference share, then cost of debt. All those sources of finance, depending on the capital structure of the company, we have the cost of equity, cost of preference share, cost of debt. The average of them is what is known as weighted average cost of capital. So we said weighted average cost of capital is the overall cost of capital. It is the cost of capital that is weighted according to the proportion of each source of capital in the company's total pool of capital. Say for example, in a company's ideal capital structure, okay, in a company ideal capital structure is the way and manner a company finances its operation. So in this capital structure, you have ordinary share capital. So you have ordinary share capital. So in that case, you calculate cost of equity. You also have preference share capital. So denoted as KP. You also have debt capital. Okay, denoted as KD. So this is an ideal capital structure of the company. Generally, the objective of the company will be to minimize the overall cost of capital. Okay, depending on the capital structure, the company wants to minimize the overall cost of capital. Want to achieve the optimal allocation of resources. So as a result of this, and that's why we have gone ahead to compute cost of equity, cost of preference share, and cost of debt. So say for example, in the capital structure, you have 1,000 of ordinary share capital, 1,000 ordinary share capital. You have 300 preference share, and you have a debt of 200. When you add it up, the total capital structure is 1.5 or 1,500. Say for example, the cost of capital calculated for equity is 20%. The cost of preference share computed is 15%, and the cost of debt is 10%. So we are now saying that the overall cost of capital is the weighted average cost of capital. Okay, is the cost of capital weighted according to the proportion. So this is the proportion: 1,000, 300, 200. Proportion of each source of finance in a company total pool of capital. Total pool of capital is 1,500. So we want to weight all these three cost of capital. That is what weighted average cost of capital is concerned. Therefore, how do you calculate weighted average cost of capital? Okay, how do you calculate weighted average cost of capital? So the weighted average cost of capital is computed WACC, calculating weighted average cost of capital, denoted as KW. So the WACC will be computed as the value of equity divided by value of equity plus value of the preference share plus value of debt, all multiplied by cost of equity plus value of the preference share divided by equity value plus preference share value plus value of the debt multiplied by cost of preference share plus value of the debt divided by equity value plus preference share value plus debt value, all multiplied by after tax cost of debt. So this is the formula for calculating weighted average cost of capital. Say for example, based on my hypothetical figures that you have here, all these hypothetical figures, if I now want to calculate weighted average cost of capital, the value of equity is 1,000. So I want to calculate the proportion of equity. So the proportion of equity will then be 1,000 divided by total value of 1,500 multiplied by cost of equity is 20% plus the proportion of preference share is 300 over 15. Here is 300 over 15 multiplied by cost of preference share, which is 15%, plus the proportion of the debt is 200 over 15. Okay, 200 divided by 15 multiplied by after tax cost of debt of 10%. Okay, so it's, say for example, there is no tax. So we're assuming that if, let's say, we even have a tax of 30%. So 1 minus 30% will give me 0.7. All right. So that is that. Just put in the formula and you get your answer. So instead of having 20%, 15%, 20%, sorry, 10%, just find the average. Find the average. In this case, my total WACC will then be equal to 1,000 divided by 15 multiplied by 20 equal, that's 13.3. So here is 13.33% plus 300 divided by 15 multiplied by 15, that's 3. Here is 3% plus 200 divided by 15 multiplied by 10, then multiply by 0.7, that's 0.93, 0.93%. Then I will find the average. My WACC will then be equal to 13.33 plus 3.93. Okay, 3.93. That's my WACC is 17.26. Here is 17.26%. Approximately, WACC is approximately 17%. So instead of having 20%, 15%, 10%, the overall cost of capital will then be equal to 17%. So this is how to calculate weighted average cost of capital. Now, what are the categories of cost of capital? What are the categories of cost of capital? Okay, categories of weighted average cost of capital. There are 3 ways in which you can calculate weighted average cost of capital. You can calculate traditional weighted average cost of capital. Traditional weighted average cost of capital. Then 2, we have project specific cost of capital, that is with project specific WACC. Okay, then 3, we have the WACC, weighted average cost of capital of the combined activities. Let me write it out in full. Weighted average cost of capital of combined activities. Okay, this is what I call WACC. This is what I call WACC. Okay, so these are the 3 categories of cost of capital. So the traditional weighted average cost of capital will be computed if information on the capital structure are given in the question. In the question, you can see information on ordinary share capital, preference share capital, then debt capital in form of bond, loan notes, or debenture, and all of that. When you have that information, that means you are supposed to calculate WACC using the traditional method. But it's a different ball game when you want to calculate project-specific WACC. The project-specific WACC is computed when a company is diversifying. Okay, we're going to get there after this. Then the weighted average cost of capital of the combined activity will be computed when a company is engaged in several activities at the same time. So instead of using different cost of capital for each project or for each activity, then you are supposed to get the WACC. All right. So all our explanation since are all about traditional weighted average cost of capital. Calculating under the traditional weighted average cost of capital, you are expected to calculate cost of equity, cost of preference share, and cost of debt. Then you now find the average using the weighted average cost of return, weighted average cost of capital formula. All the three categories of work, we use the same formula. It's the same formula. But again, like I said, using the traditional weighted average cost of capital, you will calculate the cost of equity, cost of preference share, and then cost of debt. So when we get to project-specific cost of capital, then we are going to discuss in details. So at this point, we need to have illustration. Let's have illustration quickly. So that an illustration that will incorporate all the concepts of traditional WACC. Okay, I will incorporate all the concepts of traditional WACC, cost of equity, cost of preference share, and then cost of debt. So let's have this illustration to demonstrate that. All right. Courage PSC is a manufacturer of collapsible furniture located in Abakaliki. The company is trying to decide on the cost of capital to use for the evaluation of a prospective investment project. The company has an unusual share capital of 500,000. Okay, the ordinary share capital is 500,000 of 1 naira each, currently quoted at 1 naira 17 kobo per share, cum div. So we have been given a cum div share price, meaning that we need to convert that cum div share price to ex div share price. It has also issued 200,000 naira of 10% debenture, which are redeemable at par in 2 years' time. So we have been given a redemption date for the debenture with a current market value of 1 naira 5 kobo. This 105 naira 3 kobo is cum int. Okay, is cum int. Then 100,000 naira of 6% preference share, currently quoted at 40 kobo per share. So the preference dividend and the ordinary dividend, including the debenture interest, are due to be paid, meaning that the share price of 1 naira 17 kobo, this share price of 1 naira 17 kobo is cum int price, is a cum div share price. So we need to convert that to ex div share price. Also, the market value of the preference share of 40 kobo is also cum div. So we need to convert it to ex div. Then the value of the market value of the debenture, which is 105 naira 3 kobo, is also a cum int price. Well, we need to convert it to ex int price. The ordinary dividend will be 60,000 naira. So total value of the dividend is 60,000 this year, and the directors have publicized their view that earnings and dividend will increase into indefinite future. So that means there will be growth. There will be growth because we are told that dividend will increase into the indefinite future. The company's current earnings are 500,000 naira, while the capital employed is 5 million naira. So examiner has given information on earnings, okay, and then capital employed, which means I need to calculate growth rate using the Gordon growth model because I have information on earnings as well as the capital employed. Okay, the fixed asset and working capital of the company are financed as follows. That's the capital structure. This is the capital structure of the company. The company's tax rate is 40%, payable 1 year in arrears. So you have to watch out for this. Examiner has said payable 1 year in arrears. So what that means is that when I want to calculate the cost of the redeemable debenture, instead of me to do from year 1 to the maturity date, I will do from year 2 to the maturity date because of 1 year lag. Okay, that will extend by 1 year. So advise the management of Courage PLC on the appropriate cost of capital to use for its investment. Therefore, I want to calculate cost of capital. So in this question, I have ordinary share. So I need to calculate cost of equity. So the name of the company is Courage PLC. Okay, so number one, I need to calculate the cost of individual source of finance. So the company is financed with equity, preference share, as well as the debenture. So I need to calculate cost of equity. So cost of equity, calculating cost of equity, denoted as KE. So I need to ask, how am I going to calculate the cost of equity? Like I explained when I was explaining the concept, there are 3 ways you can calculate cost of equity. Cost of equity using dividend valuation model, cost of equity using capital pricing model, or cost of equity can be calculated using Miller and Modigliani. And I said, when you have information of dividend and the share price, then you need to calculate cost of equity using the dividend valuation model. In this question, we have dividend and share price. Therefore, cost of equity will be calculated as the current dividend. It also depends using dividend valuation model. The formula you are going to use will depend on whether dividend is growing or will remain constant to perpetuity. Examiner has told us that the directors of the company has publicized that the dividend will increase into the indefinite future, and we are given information on earnings and the capital employed. That means we are going to calculate growth rate. Therefore, current dividend multiplied by 1 plus the growth rate divided by XDIV share price plus the growth rate. All of this multiplied by 100 over 1. So this is the formula that we are going to use to calculate the cost of equity. Therefore, I would then say cost of equity equal to, what is my current dividend? We need to go back to the question. The current dividend, go and check where you have information on dividend. We are told that the ordinary share dividend will be 60,000 naira this year. 60,000 naira is the value of the dividend. So I need to go and do working for my dividend per share. So this would be for cost of equity, cost of preference share, cost of debenture, then WACC. Then the last paragraph will be for workings. Let's start our working from here. Hope this will be sufficient. So working number 1, we want to calculate dividend per share. So that means we want to use par value for our calculation. So I want to calculate dividend per share. So dividend per share is calculated as total dividend divided by number of shares, number of ordinary share. Okay, total dividend is 60,000 naira according to the question. Number of shares is 500,000. Okay, so what do you have as dividend per share? 60 divided by 500 equal, that's 12 kobo. 12 kobo is the dividend per share. Okay, 12 kobo is the dividend per share. Then the number 2 workings that we are going to do according to the question, the share price given to us is cum div. So we need to convert the cum div to x div share price. So I would then say x div share price. Okay, the x div share price will be the current dividend, will be the cum div. Cum div, let me rewrite that. Cum div share price. The cum div share price according to the question is 1 naira 17 kobo. Let's go and confirm. Here, the cumulative share price is 1 naira 17 kobo. Okay. Then the current dividend we have gotten is, which is 60,000. So dividend per share is 12 kobo. So that would be 1 naira 17 kobo minus 12 kobo. So minus the current dividend. So the current dividend is 12 kobo. So the difference is 1.05. This represents the ex-div share price. So then the next working we are going to do, because in the question we are told that there is growth in dividends, so we need to calculate growth rates. Growth rates, G. So this will be computed using the Gordon growth model. Okay. This will be calculated using Gordon growth because information on earnings and capital employed are given. So using Gordon growth model, G is computed as return on rate of return multiplied by the retention rate. So I need to go and calculate the return on capital employed. So the return on capital employed is earnings divided by capital employed. Okay, multiplied by 100 over 1. According to the question, earnings is, let's go and check. The value of earnings, according to the question, the value of earnings is 500,000 naira. Capital employed is 5 million naira. Okay. 500,000 divided by 5 million. Okay. 500,000 divided by 5 million multiplied by 100 over 1. That should be 10%. Okay. Return on capital employed is 10%. Well, then we need to calculate the retention rate. The retention rate is earnings minus dividend, total earnings minus total dividend divided by total earnings, multiplied by 100 over 1. Earnings is 500,000. Dividend is 60,000. Okay, divided by 500,000 multiplied by 100 over 1. So retention will then be equal to 440 divided by 500 multiplied by 100%. That's 88%. So this is 88%. So since retention is 88% and we have calculated rate of return to be 10%, therefore our growth rate will then be equal to 10% of 88% multiplied by 100%, which will give us 8.8. 8.8% or approximately 9%. So growth rate is approximately 9%. Now that we have computed growth rates, we've also computed ex-div share price to be 1 naira 5 kobo. Then we have dividend of 12 kobo. We can then proceed to calculating the cost of equity using the dividend valuation model. So the current dividend is 12 kobo. Growth rate is 9%. 1 plus 9% will give us 1.09. The ex-div share price is 1 naira 5 kobo. Okay, 1 naira 5 kobo plus the growth rate of 9%. Then all of this multiplied by 100 over 1. So bring out the calculator. I would then say 0.12 multiplied by 1.09 equal then divided by 1.05 equal plus 0.09 equal multiply by 100% equal, that's 21.45. 21.45 KE is equal to 21.45%. Approximately, it is 21%. KE is approximately 21%. So now that we have computed cost of equity, we need to calculate cost of preference share. Number 2, calculating cost of preference share, KP. So we need to ask, what kind of preference share? Is it a redeemable preference share or irredeemable preference share? According to the question, we are not given the redemption date for the preference share. That means it is irredeemable preference share. So since it is irredeemable preference share, then the cost of irredeemable preference share is computed as fixed dividend divided by ex-div share price multiplied by 100 over 1. So in that case, the cost of irredeemable preference share will then be equal to, I will then go to the question, what's the dividend? The dividend, according to the question, we are told that dividend is 6% preference share. So 6% of the nominal value. The nominal value of the preference share will be 1 naira. Look at nominal value of the preference share is 1 naira. Therefore, 6% of 1 naira will be 6 kobo. Okay, will be 6 kobo divided by ex-div share price, because we are told that preference dividend has not been paid. So the market value of this 40 kobo will need to be converted to ex-div share price. So let's go and do working for that. So we want to calculate ex-div share price for the preference dividend. Working number 4. Ex-div share price. Ex-div preference share price. Preference share price. So it's the same thing. So ex-div share price is equal to the cum div share price minus the current dividend. Okay, so the cum div share price we are told is 40 kobo, 0.40 minus dividend. The current dividend is 6 kobo. Okay, 0.06. How do I arrive at that? That's 6% multiplied by 1 naira. 6% of 1 naira is 0.06. So this will give us 34 kobo, 0.34 per share. So that's the ex-div share price. Now that I have the ex-div share price, I can then proceed to calculate the cost of irredeemable preference share. So here is 0.06, which is 6% of 1 naira, divided by ex-div share price is 0.34. Then multiply by 100 over 1. This will give us 6 divided by 34 equal multiply by 100 equal 17.65. This is 17.65%. So approximately the cost of irredeemable preference share is approximately 18%. So number 3, we need to calculate cost of redeemable debenture. So calculating cost of redeemable debenture, KD. Okay, because it is redeemable, we are told that this debenture will be redeemable in 3 years time. Is it 3 years? Let me confirm. Where is the information again? Yes, and it has also issued 200,000 naira of 10% debenture which are redeemable at par in 2 years' time. So again, are we given tax rates? Yes, there's a tax rate. Remember, debt has tax deductibility benefits. So once you have tax, then you are going to pay less. The company will pay less. So we need to go and account for that. And we are told that tax are payable 1 year in arrears. So let's go and calculate cost of redeemable debenture. So to do this, I'm going to use only one table. Remember, you are supposed to assume two discount rates that will produce two opposing NPV. One discount rate will give you a positive NPV, another discount rate will give you a negative NPV. Then you interpolate in the IRR formula. So I will use only one table. So let's start from 10%. So we assume 10%. So we use this 10% to compute NPV. So create a column for year, description of items, okay, cash flow, discount factor, then we have the present value. Okay, so we are starting from 10%, we are assuming 10%. Okay, let's complete the table. So year 0, we have the initial outlay, we have the current value, the current market value of the debenture. So the maturity dates of this debenture is in 2 years' time, and we are told that tax is paid 1 year in arrears. In this case, we are not going to start from year 1. So because the interest we are going to pay, we start paying that interest from year 2 because tax is paid. There is tax benefit of 40%. So this will be from year 2 to 3. Remember, the maturity date of this debenture is in 2 years' time. But because of the fact that tax is paid 1 year in arrears, then you are going to extend it by 1 year. So the tax you are supposed to pay in year 1 will be paid in year 2. The tax of year 2 will be paid in year 3. And that is why the maturity date is technically extended to year 3 because of tax effects. So instead of starting from year 1, we are starting from year 2. Okay. Then this will be interest, the fixed interest. Then at the end of the useful life of the project, which is year 2, it will be redeemed. This, of course, the redemption date is in 2 years' time. So don't say because of tax, you now intend to be redeemed in 3 years. No, you are not redeeming it in 3 years. It will be redeemed in year 2. But because of tax effects, that's why we are extending it to year 3. Okay, so redemption value. So I will then go to the question, what is the current value of the debenture? Okay, what's the current value of the debenture? According to the question, we are told that with the current market value of 105.3, so the current value of the debenture is 105.3, and the debenture interest has not been paid. So we need to go and calculate cum-int price. However, what is the percentage of this? What's the coupon rate? The coupon rate of the debenture is 10%. So I don't need to waste much time on this. What you need to do is to go and adjust for tax first. That's working number 4, working number 5 now, working number 5. So we need to calculate X-int price, X interest price. So the X-int price is computed as the cum-int price minus the interest. So the cum-int price is 105 naira 3 kobo. The current interest, the coupon rate, the interest rate of the debenture is 10%. So minus 10, this will give us 95.3. So that represents the X-int price, because you don't use the cum-int price to calculate cost of debenture. It has to be X-int price. Then working number 6. According to the question, there is tax, so we need to calculate post-tax interest. Post-tax interest, So to get the post-tax interest will be calculated as interest multiplied by 1 minus tax rate. So interest is 10%, tax rate is 40%. 1 minus 40% will give us 0.60. So here will be equal to 6. So at that point, let's go ahead and complete. Let's complete. So the current value of the debenture is 95.3. That's the X int price multiplied by 1 multiplied by 95 will give us 95.3. So let's complete our table. Let's complete our table. Okay. All right. Okay. Let me adjust this one a little bit. Push this one to the left also, 10%. So this one too. So this will be for the NPV. This one at 10%, present value at 10%. So I don't know the next one. Okay, so that's that. Then the interest, we have calculated post-tax interest to be 6 naira. So I need to calculate annuity factor of year 2 to 3. So let's go and do working for annuity factor of year 2 to 3. So working number 7, annuity factor. Okay, of years 2 to 3. So to get the annuity factors of year 2 to 3, you need to calculate annuity factor of year 1 to 3 first. So annuity factor of year 1, of course, you already know the formula for calculating annuity factor. Annuity factor is computed as 1 minus 1 plus r raised to power minus n all divided by r. So for years 1 to 3, so bring out the formula. For years 1 to 3, this will be equal to 1 minus, okay, cost of capital is 10%. We're assuming 10%. So cost of capital is 10%. Let's do it this way to make it, let me shift a little bit. So years 1 to 3 at 10%. Okay. So this will then be equal to, I will say 1.1 raised to power 3 minus equal minus 1 equal divided by 0.1 equal. That's 2.487. Here is 2.487. So I need to calculate annuity factor of discount factor of year 1. So discount factor of year 1 at year 1 only. 10% will give us 0.909. So the difference will then give us annuity factors of years 2 to 3. Okay, which is 2.487, 2.487 minus 0.909. Sorry, 2.487 minus 0.909 equal 1.578. Here is 1.578. So that's the annuity factor of years 2 to 3. So let's go and calculate now. Let's continue. So here will be 1.578. Okay. Then this debenture will be redeemed at par. At par means at 100 naira. So discount factor at year 2. For year 2 at 10%, 0.826. This is 82.6. Then I would say 6 multiplied by 6. 1.578 multiplied by 6 will give us 9.45 or 9.5. Okay, this is 9.5 approximately. So 9.5 plus 82.6 equal 12.1. What am I saying? No. 82.6 plus 9.5 equal 92.1 minus 95.3. That's 3.2 minus 3.2. So NPV is minus 3.2. All right. So we assume 10%. We got a negative NPV of 3.2. Let's assume a higher discount rate. So, sorry, a lower discount rate. So we're assuming 10% and then 5%. So let's assume 5%. So this will still remain 1. Multiply by 95, that's 95.3. So at 5%. So let's go and calculate annuity factor of year 1 to years 2 to 3 at 5%. Okay, so at 5% discount rate. So let's calculate annuity factor of years 2 to 3 at 5%. So this would be 1.05 raised to power 3 minus equal, okay, minus 1 equal, okay, divided by 0.05 equal, that's 2.723. Here is 2.723. So I need to calculate discount factor for year 1 at 5%. So 1.05 raised to power 1 minus equal, that's 0.952. Here is 0.952. So 0.952, 2.723 minus 0.952 equal, that's 1.771. 1.771. Okay, so that's the annuity factor of years 2 to 3. Okay, so let's continue. All right, this is 0.952. This is 1.771. Is it? Yes, it is. So 1.77 multiplied by 6. So the total interest is 10.6. This is 10.6. That's the PV of the interest. Then 100 multiplied by 0.952 will give us 95.2. Let me rewrite it. 95.2. Is it 95.2? Is it 0.952? Let me confirm. 0.952 discount factor. Yes, 0.952 is correct. So that we don't make a mistake. So at this point, I would then say 95.2 plus 10.6 equal, then minus 95.3 equal, that's 10.5. Here is 10.5 positive. So since we assume 5%, we got a positive NPV of 10.5. We assume 10%, we got a negative NPV of 3.2. So we need to calculate the cost of redeemable debenture, which is the internal rate of return, computed as lower discount rate plus the NPV of the lower over the NPV of the lower plus the NPV of higher discount rate multiplied by higher discount rate minus the lower discount rate. Okay, so A is the lower discount rate, which is 5, plus NPV of the 5 is 10.5, divided by 10.5 plus NPV of higher 3.2. So higher plus higher rate of 10% minus lower rate of 5%. So mathematically, the cost of debt, cost of redeemable debts will then be equal to 10.5 plus 3.2 equal to 13.7. So 10.5 divided by 13.7 equal, then multiply by the difference between 10 and 5, which is 5, equal, then plus 5 equal, that's 8.83%. 8.83% is the cost of a redeemable debenture. So approximately the cost of redeemable debenture is approximately 9%. So now that we have cost of redeemable debenture, we need to calculate the weighted average cost of capital. Okay, we want to calculate the weighted average cost of capital. That will be working up. That will be step 4 now to calculate the traditional WACC. So I will then say calculating weighted average cost of capital denoted as KD. So, sorry, KW. So I can either use formula or I use tabular method to get my WACC. So using the formula, I will say WACC is equal to equity value over equity plus debt over equity plus preference share plus debt multiplied by cost of equity, okay, plus value of the preference share over equity plus preference plus debt multiplied by cost of preference share, okay, then plus value of the debenture over equity plus preference share plus debt multiplied by the cost of the debenture 1 minus tax. Okay, so that's that. Then value of equity, I need to go and calculate the market value of the equity. I don't know it, so we need to go and calculate market value of equity now. To calculate market value of equity and then the market value of preference share, market value of the debt. That will be working number 8. So calculating market value. Okay, so value of equity will be calculated as number of shares multiplied by xdiv share price. So the value of debt, value of preference share is the same thing. Value of preference share will be calculated as number of shares multiplied by xdiv share price. The value of the debt of the debenture will be calculated as the nominal value multiplied by x int price divided by 100 naira, because debt is always quoted at 100 naira per unit. So with this, I would then say equity value is equal to number of shares is 500,000. We have 500,000 shares multiplied by the market value of the xdiv share price is 1 naira 5 kobo. That should be our second working number 2. Yes, this is it. Xdiv share price is 1 naira 5 kobo multiplied by 1 naira 5 kobo. So this is, we have 500,000 multiplied by 1.05. That's 525,000. This is 525,000 naira. Okay, then the value of the preference share. The number of preference shares is, let's go and confirm from the question. The number of preference shares is 100,000 shares, because the share capital is 100,000 naira divided by 1 naira nominal price. That will give us 100,000 shares. So 100,000 shares multiplied by xdiv share price of 34 kobo. That's 34,000 naira. So 100,000 shares. Here is 100,000 shares. Okay. Multiply by 34 kobo. That's 34,000 naira. Well, they arrive at 34 kobo. That's working number 5 or thereabouts. No, working number 4. Yes, this is the ex-div preference share. Okay, so that's that. Then let's calculate the value of the debenture, which is D. The nominal value of the debenture we are told is 200,000 naira. Multiplied by X int price. X int price is 95 naira. 95.3 divided by 100 naira, because debt is always quoted at 100 naira per unit. Therefore, what do you get? So 0.953 multiplied by 0.953 multiplied by 200,000. That's 190,600. Here is 190,600. So add it up. Plus 34,000 plus 525,000. That's 749,600. 749,600. This represents the total market value. Total market value of equity, preference shares, and then debt. So 749,600. I can then go ahead and complete the WACC. So the value of equity, so KW WACC is equal to value of equity is 525,000. Market value of equity is 525,000 divided by total value of 749,600 multiplied by cost of equity of 21%. We calculated 21% as cost of equity. That was the first. So the value of equity is 21%. That's the 21%. Cost of equity is 21%. Cost of preference share is 18%. Then cost of the debenture is 9%. So let's complete our work quickly. So plus value of the preference share is 34,000 divided by total value of 749,600 multiplied by cost of preference share of 18% plus the value after tax plus the value of the debt is 190,600 divided by total value of 749,600. So the after tax cost of debt we computed is 9%. So there is no need to come and put 1 minus tax again, because we've already adjusted for tax before we got the cost of redeemable debenture. Therefore, KW will then be equal to, bring out your calculator, 525,000 divided by 749,600. Okay, equal, multiply by 21, equal, that's 14.71. Here is 14.71% plus 34,000 divided by 749,600 multiplied by 18 is my cost of preference share 18%. Let me confirm first. Yes, it's 18%, correct. Okay, because you need to be sure. That's 0.82%. Here is 0.82% plus 190,600 divided by 749,600 equal, then multiply by after tax cost of debt of 9 equal, that's 2.29. Here is 2.29%. So our final answer, 14.71 plus 0.82 plus 2.29 equal, that's 17.82, 17.82%. So approximately WACC is approximately 18%. This is the weighted average cost of capital. So alternatively, I can use tabular method to get the same thing. To use the table, then I will create a column for the type of the securities in the capital structure. I will create a column for the market value. Okay. I will create a column for the proportion of the cost of capital computed. Okay. Then I will also create a column for hash total. So we have ordinary share capital. We also have preference share capital. Then we have, let me rewrite this. Ordinary shares capital, we have 6%. Preference share capital, then we have 10% debenture. So the value of ordinary shares, the market value of ordinary shares, we got 525,000, 34,000 for preference share, then 190,600 for the debts, for the debenture, so which gave us the total of 749,600. That's the total market value. Then we calculated cost of equity to be 21%, cost of preference share to be 18%, the cost of the redeemable debenture to be 9%. So to get the hash total, you multiply 525,000 by 0.21. That's 110,250. So 34,000 multiplied by 0.18. That's 6120. Then 190, 600 multiplied by 0.09. That's 17,154. 17,154. So I get the total of that. So find the total of this. So this will then be equal to 17 plus 6120 plus 110,250 equal to 133,524. 133,524. So to now get the WACC will then be equal to hash total divided by total market value multiplied by 100 over 1. So then the WACC will then be equal to 133,524 divided by total market value of 749,600 multiplied by 100 over 1. Okay, this should give us, so I will say divided by 749,600 equal to, that's 17.81. So WACC is equal to 17.81%. Approximately, WACC is approximately 18%. So which is consistent with what we got using the formula method. So 18% is the same thing as using the tabular method. So this is how to calculate the traditional weighted average cost of capital. So finally, let's talk about, based on the scope of today's outline, let's talk about, I think we have the assumptions of weighted average cost of capital. That's the only thing outstanding. Let's confirm. So we have discussed weighted average cost of capital, how to calculate weighted average cost of capital. We have discussed the categories of weighted average cost of capital, where I've mentioned traditional weighted average cost of capital, project-specific WACC, as well as the weighted average cost of capital of the combined activity. Finally, let's talk about the assumptions of weighted average cost of capital. There are three or four underlying assumptions, at least key underlying assumptions of weighted average cost of capital. Let me create a space so that I can write it down. Okay. Underlying assumptions of weighted average cost of capital. Okay. So let's use this space. Assumptions of weighted average cost of capital. So there are three or four underlying assumptions there are more than that, but I will just mention three or four. The first assumption is that the debt equity proportion will remain constant. Okay. The debt equity ratio, or proportion will not change. Okay. That is, in the capital structure, the percentage of debt and equity will remain the same. So that's for weighted average cost of capital to be possible, this assumption must apply. Then number two, the projects will be financed from the company's total pool of capital. Okay, projects will be financed from the company's total pool of capital. Okay, so the value of, you have your equity value, ordinary share capital, preference share capital, then debt capital. Add all of them together, that will give you the total pool of capital. So we are assuming that the project will be financed using the company's total pool of capital. Then number three, the project, the operating risk. Okay, the operating risk will remain constant. Okay, another assumption is that operating risk will remain constant. That is, the risk associated with the variability of the company's cash flow will not change. Okay, the risk will not change. All right, so that's that. Then number four, another assumption is that the project size, okay, the project size is small relative to the company size, relative to the size, let me write this one, relative to the size of the company. Okay, relative to the size of the company, such that any changes in the projects will not make any material effects. Any changes will be insignificant. Okay, it will not have any material effect on the company. So now, these are the underlying assumptions for weighted average cost of capital. So for weighted average cost of capital to be practicable, all these assumptions must be present. So if any of these assumptions are not met, then we cannot use weighted average cost of capital to compute the cost of we cannot use weighted average cost of capital to appraise any project. Okay, to appraise any project. So that is end of today's class. So far, we have discussed. We started with the introduction to cost of capital. We started with the introduction to cost of capital. We talked about the importance of cost of capital. we talk about how to estimate cost of equity, the meaning of cost of equity, and then methods of estimating cost of equity. Under method of estimating cost of equity, we only discuss the dividend valuation model. And I said that when we get to capital asset pricing model, we are going to discuss in details because capital asset pricing model is a topic on its own in strategic financial management or corporate finance. But I demonstrated for you how to calculate cost of equity using dividend valuation model. Then we'll move to discussing the cost of preference share, how to calculate the cost of preference share. We'll talk about cost of debt and how to calculate cost of debt. I also inform you on on the types of debt, where I mentioned traded debt and then the non-traded debt. So finally, we talk about weighted average cost of capital. I show you how to estimate weighted average cost of capital using traditional method. Then I now said that in our next class, we are going to be looking at project-specific weighted average cost of capital and the weighted average cost of capital of the combined activity. Then, of course, I just mentioned the four underlying assumptions of the weighted average cost of capital. So that will be the end of today's class. I will see you next time by the grace of God. Bye-bye.